Morning, it's Jeffrey Christian, CPM Group from New York. I'm joined today with Rohit Savant and Carlos Sanchez of CPM Group to launch and brief you on the 2022 Gold Yearbook from CPM Group. A lot to cover. I apologize for the voice. Rod Stewart, in the liner notes to Every Picture Tells a Story, has a line in the credits saying local abrasives courtesy Matus Rosé. I would say local abrasives courtesy Guinness. So let's jump into it. The first thing I have to do is thank our sponsors and our partners. We have a few new sponsors: Europa Bullion, Gold Silver Vault, which has subsidiaries of Idaho Armored Vault and Profits Plus, which is a precious metals capital management company. ISRI, the Institute of Scrap Recycling Industry, has been there with us since we started accepting sponsors in the mid-90s. Kitco, Corlin Economics, Monix Precious Metals, NOAA Capital Markets, institutional investor in South Africa, and Sabin Metals Corp. We also have partners in China, the China Gold Association, China National Gold Corp, and Beijing Yiqing Technology, which is looking to use technology to provide precious metals and precious metals related services within China. They have been sponsors and partners. They translate our gold, silver, gold and platinum yearbooks into Chinese and distribute them in the Chinese market. We also have several media partners, including Glacier Publishing, which produces the Northern Miner, Kitco, Kitco Metals, Metals Daily, and Prospector News. We have distributors, Gold Blocks, Gold Silver Central, which are companies in Singapore, Interact, which distributes research on financial markets, Prospector News, Southeast Asian Consulting, and the Morgan Report's in here too. It's been more than a half a century of these reports. They started off as J. Aaron reports in the oldest one I have is 1971. I used to have a complete set in my office when we were still at J. Aaron Goldman Sachs. And one day someone was given the option to resign or be fired. And while I was out to lunch, he was cleaning out his office and he took my complete set. But we do have copies starting in 1971. The history of gold market research, gold, silver, platinum group metals markets are extremely secretive markets. A lot of information on mine production because mining companies, public mining companies, have regulatory obligations to release information, and they have an economic incentive because they want investors to invest in their companies. But when you get into secondary recovery from scrap or fabrication demand, investment demand, central bank activity in the past, it's very secretive. Central banks are more transparent now on their gold than they used to be over the last 2 decades or so. But those other sectors are very secretive. And when the gold market was moving away from Bretton Woods with a fixed gold price, and it was quite clear even in the late 50s that this would have to happen. And you started seeing reforms in Europe in the 1960s. And Harry Oppenheimer, who was running the Anglo-American / De Beers group of companies, put together a team of economists and market researchers to produce this book that you see on the right-hand side of the screen, Gold. This is the 1969 version. And he said, the question was, can Anglo-American and Anglo-Gold do with gold what De Beers does with diamonds, which is to be the buyer and seller of last resort and thus stabilize prices? And the answer to whether or not we can do that in gold is how much gold is out there and who owns it. So he put together a team of researchers. They did an excellent job. We still have that report. It's right behind me on my desk. And they said there's about 320, 330 million ounces of gold held by investors worldwide. A lot of it in India and France, other European countries. About 20 million ounces, I think, were estimated to be in the United States. And then there was, at the time, about 1.3 billion ounces held by central banks. And thus, there's a lot of gold out there that if you try to stabilize the price and you become the buyer of last resort when prices are weak, you'll start seeing all this stuff coming in and you'll have to buy it. So Harry said, okay, so we can't do for gold what De Beers does for diamonds. Thank you. And you're all can go your separate ways. Not everybody. Actually, a couple people who were involved in that report stayed at Charter Consolidated, Minorco, Anglo Gold, and became high-level officials, executives in those companies. But the others were sort of let loose. Konstantin Michailopoulos did central bank work. Rosemary Van Musschenbroek, the M in CPM, was doing European market research, and a few others. And Consolidated Goldfields, which was a gold mining company and a rival to Anglo Gold at the time, Consolidated Goldfields and Jay Aaron sort of hired a bunch of these people as consultants. And we shared the consultants, and we each were doing research on gold. And that was the origin of the Jay Aaron research operation and the Jay Aaron Gold Reviews and Outlooks, circa 1971. We continued to do that. We also, Jay Aaron, I wasn't there until 1980, also did silver reports and very brief things on platinum and palladium. We changed the layout, and you can see the blue book in the center. Goldman Sachs bought us in 1981, and we went to these commodity market perspectives. And then CPM Group spun off of Goldman Sachs in 1986. Initially, our reports had silver covers, nice precious metal-y. We changed from the precious metals survey to precious metals yearbooks around 2005, when Jay Wiley wanted to be our publisher. And we went to these hardbound books, and then we went to perfect bound books. And now, technology being what it is, we distribute our books by as PDF, ebooks. So we've been doing these reports for more than half a century, and we have this enormous body of information. We've been using these twice weekly videos we're doing to sort of do a brain dump and put together a lot of the historic information that we have in a format that's available to other people. Library of Congress, the New York City Public Library, and the library at Baruch University each have a complete set of the CPM Group yearbooks and surveys that we started publishing in 1986-87 after we left Goldman. So the information is out there, but it's kind of hard to retrieve unless you know where to look for it and you're looking for it. So we do that. Now, I wanted to talk a little bit about the economic environment, but let's start with the gold price. You can see the gold price was basically trading between, say, 1,200 and 1,400 2013, after it came down from its record run in late 2011. It moved a little bit lower, but it spent most of the time from 2013 to 2019, the middle of 2019, in that $1,200 to $1,400 range. And that will become important when ROA is showing you data on central banks. You'll be able to see the correlation between prices and central bank buying patterns. In 2019, especially in the second half, we saw the price break above 1,400 and move higher, or break above 1,500. It traded around 1,500, more or less, up to 1,560 in the second half of 2019. Early 2020, it broke above 1,600, and it started to move higher. And then it was really in July of 2020 that the gold price broke above 1,800 and made that run to that record price of, I think on a settlement basis, it was $2,058. On an intraday high, it was probably about $278 in early August of 2020. Price came down and it consolidated basically between 1,780 and 1,880 in late 2020 and early 2000 and through 2021. There were 3 spikes down to 1,680 Each of them lasted like a day, maybe 2 days. But basically the price traded between 1780 and 1880 for much of that time. And it's very funny because gold bugs will say, why is the gold price so low? And the reality is that the gold price in 2021 was a record average price in 2021. It was about 1.7% greater than the annual average price in 2020, because 2020, you'll remember the gold price, you can see, traded below 1800 for most of the first half, for all of the first half. It only broke above 1800 in July and traded above that in the second half. So you actually had record annual average prices last year. They continued to consolidate in that range in the first 2 months of this year. Then Russia invaded Ukraine, and the price spiked up to a new high around $2,080, early days of the invasion. And then the price came down, and it's been trading, it's around 1930 as we speak today. And it's been trading at a premium that reflects the fact that you have a major ground war and invasion underway in Europe, which has severe implications for global financial, economic, political, and social stability. You have the biggest refugee crisis in Europe since World War II. You have the risks of this expanding to a greater war. And you have a lot of other issues. So there's a war premium in the gold price. But I think it's very important to understand the gold price has been trading at record prices. And when people say gold prices are so low, they're speaking about their beliefs, not the reality of the gold market. And they'll say, well, yes, but you know, compared to the stock market or compared to this, that, or the other thing. But if you look at the correlations between gold prices and those other variables, independent variables, you'll find that they've never really traded in close concert. They change based on each market's fundamentals, and they'll continue to change on each market's fundamentals. And so there's not a good theoretical or empirical basis for saying, oh, gold prices should be higher because X, Y, or Z are higher. Now, related to that and going into the economic things, I want to talk about two things to sort of say you've got to think in terms of perspective. We heard in 2020 and 2021 that 2020 saw the deepest recession since the Great Depression. Actually not, because you can see here in 1947, we had a very deep recession. It lasted 1 year, but it was far deeper and greater than the one that we saw in 2020. 2020, we saw about a negative 3% contraction in US gross domestic product, real inflation adjusted gross domestic product, compared to about a 12-year period during the Great Depression, during which time you saw about a 5-year period where we had a 7%, 8%, 14% contraction in real economic activity in the United States. And in 1947, as I said, you had about a 12% contraction over 1 year. And 1947 is important too, because the debt to GDP ratio in the United States that year was 122%, which is higher than it is now. And if you look at it from 1947 until 1981, we paid down that debt as a percentage of GDP to a very low level. And it was only with the tax cuts and the increased defense spending and other issues that came along in 1981, 82 that you started seeing the debt to GDP ratio rise once more. But again, the key that I wanted to make is we had a 3% contraction in the US economy in 2020, and it was inspired or manufactured by government actions to try to control the pandemic. It wasn't due to economic trends that were abroad, which is what causes most recessions. In fact, every recession except the current one, the one in 2020. So you got to put it in perspective. Yeah, it was the deepest recession since the Great Depression, but it was 3% in 1 year, not 14% or 10% for 12 years. The same lack of perception is now at work on inflation. We have the highest inflation rate since 1982. We do. Inflation is as high as it was in 1982. In 1982, it was coming down from 14%. And you had a 14-year period of what was called hyperinflation, inflation that was consistently and persistently above 5% for 14 years. So the reality is that the economy in the United States and on a global basis is radically different and changed. Financial markets are radically different and changed than they were in the 1970s. But regardless of any of the fact that the reality has shifted completely, the truth is that, yes, we have the highest inflation since the early 1980s, but the inflation that we saw for 14 years from 1968 to 1982 is nothing like the spike that we have now. And I know there are a lot of people who like to sell precious metals predicated on the view that the world's going to collapse and that inflation is hyperinflation and we're going to go into stagnation and the dollar is going to collapse, et cetera, et cetera, et cetera. I found an article on the weekend that was great online. It was the existential threat of existential threat rhetoric. And it was all about the fact that existential threat is not what people call, people misuse that term. I won't go into existentialism today, but I will say the threat of existence is not an existential threat. But that term, like Nazi or fascist or liar, is really depreciating the public rhetoric. A lot of things are not actually threats to our existence. They're problems, they're major problems, they could become larger problems, they probably will become larger problems, as this chart shows, but they're not necessarily a threat to the existence of life as we know it. So our expectation that the economy, which has been pretty weak in the United States, parts of Europe, China, in the first quarter of this year, will improve over the next 9 months and into 2023. We do have a recession in the industrialized world that we are projecting for 2024, 2026, someplace in there. And it's a significant recession. It's not the biggest recession. We don't think it will be the biggest recession since the Great Depression. We don't think it'll be as big as the spike down that we saw in 2020, but it may be more persistent because it'll be caused by economic trends as opposed to government manufacturing shutting down the economy. So our expectation is that the economic outlook improves over the next 9 months, especially in the second half of this year. And our expectation is the gold price may well come back off and trade between, say, 1780 and 1880 once again in the second half of this year. And it'll do that for several reasons. First off, we hope that the Russian invasion of Ukraine is sort of under control by the middle of this year. We think that through the second quarter, it's going to continue. But this is a war. You can't project a war. You can run through different scenarios. And it could get very nasty and persistent. But our expectation is that more than likely, by the end of the second quarter, there'll either be some resolution, it'll probably be a stalemate, and you probably have Russian troops occupying parts of the Ukraine against the Ukraine's will. Or there'll be some clear sign toward a resolution. So some of that war premium that's keeping the price basically above 1880, 1900 right now may dissipate in the second half of this year. At the same time, you're probably going to see interest rates rise, and you're probably going to see inflation rates decline. I'll get into inflation in a second, but the reality is that interest rates probably are going to rise. And we've seen the first increase of 25 basis points by the Fed in March. They indicated that they're not thinking about 2 or 3 increases this year anymore. They're thinking maybe as many as 6. You could see the Fed funds rate and short-term Treasury bill rates running around 3% by the end of the year. 3% interest rates are probably not enough to throw the world into a recession or create an existential threat to capitalism. Probably not enough to keep the stock market from rising to new highs and records in the second half of this year. And probably not enough to discourage investors from buying gold. High rising interest rates are negative for the economy and for the stock market and for gold and silver when they're high and they're rising to even higher levels. And again, go back to the 1970s where you had 4, 5, 6% nominal Fed funds rates, and then they went to 19%, and T-bills went to 21%. That is the kind of increase that can really turn off an economy, throw you into a recession, crush inflation, and drive gold prices down. We're not there. We're at 25 basis points for the last 8 years. We're going to continue to see very low interest rates. Even if interest rates rise 3%, they'll be at 3%, which is lower than it's been. Fed funds rate has been since most of the period prior to, say, 2005. And on a real inflation adjusted basis, the real inflation adjusted rate will probably be around -3 to -5%, depending on what the inflation rate is. So we're not spooked by interest rates. They will create some headwind for gold prices, but not a significant headwind, at least in 2022 and possibly even into 2023. As 2023 progresses, things will be changing. And you're now starting to see some major investment banks' economics departments saying, hey, we could see a recession by the end of 2023, which is cute because we've been saying 2024, 2026 as our target. And, we're sometimes off plus or minus 1 year in guessing when a next recession is going to occur. The statistical correlation between changes in the Fed funds rate and changes in gold prices is 0.4%. The statistical relationships between T-bills and T-bonds, I'll show you at the end of the economic section, -1% to 1% over time, right? They're uncorrelated assets, which is one of the reasons why gold is so great and powerful as a portfolio diversifier, because there are times when bond prices and gold prices are rising. There are times when they move in opposite directions. There are times when they don't, they're uncorrelated. And you look for that in a portfolio diversification. You don't look for something that has a high negative correlation to your other assets. You look for something that has no correlation to your other assets. So you really have a diversified portfolio. But we don't see interest rates being negative, particularly heavily negative for gold. We also expect inflation to come down. And if you think about it, if you look, this is year over year inflation rates in the United States. The blue is the headline, the maroon is the core. In the first quarter of last year, core inflation was running 1.3, 1.2, 1.6%. Headlines started rising because you started seeing oil prices rising and oil-based energy prices rising and used car sales. And in the second quarter, you saw much higher inflation rates. I'll show you the quarter-to-quarter data because this really is very important and people don't look at it. You can see that March through June, you had higher inflation. It came off in the third quarter for a variety of reasons. And then in the fourth quarter into January and February of this year, we only have January figures here, you saw it rise again. And there's some big differences. In the period March to June, almost all of the increases were like 40% plus in oil-based energy prices and used car sales. Everything else was still pretty low, but used car sales prices were rising very sharply because people were buying more cars and they couldn't get new cars. And the stock of used cars was somewhat limited, at least in the United States. Non-oil-based energy prices actually were low. Fast forward to the fourth quarter, when you saw these higher inflation figures again, the inflation was much more generalized. You saw energy costs high, not only for petroleum-based energy, but also for electricity. You saw a wide range of food products and food bought for consumption in the home and food bought out for consumption in restaurants, all rising sharply. You were coming out of the economic recession of 2020, and people were starting to open up their restaurants again. And you saw inflation more generalized across a number of things. So pay attention to those month-to-month changes because they'll tell you where you are right now. They won't tell you where you are in the bigger war, but they'll tell you where you are in the battle that you're facing at a given time, if we can use the metaphor of the current period. Now, going back to year-over-year figures, you see that the inflation rates were very high from April through January of this year because we're measuring 2021 high price levels during a very strong economic recovery to 2020 price levels when you had a global lockdown, no one was buying anything, and the pandemic was at its worst. Fast forward into 2022, and what you'll see is that price levels are going to stay high. Some of them will move even higher thanks to our good friends in Russia invading the Ukraine, and other factors. But you will be measuring high price levels in 2022 compared to high price levels in 2021. So price levels will stay high, prices will stay high. We'll be paying more for all of these things, but the percentage increase in inflation in prices, which is what inflation is, will decline. Simple arithmetic. That's why the Fed thinks that by the end of 2022, you might see CPI around 5%, 4 to 5%. We think that you might see it as low as 3 to 4%. And that will take some of the inflation premium off of gold prices. So that's what real inflation is, as measured by real economists, by the way. People say, well, yeah, but with the money supply growth as great as it has been, that's got to be inflationary. And if you're as old as I am, you've been hearing that since the 1970s. And it's never actually been true. Well, it was in the 70s. But after Paul Volcker took over the Fed in 1979 and changed the way monetary policy is practiced, not only in the US Fed, but around the world, you've seen numerous spikes of higher growth in money supply, even as inflation declined for most of that period of time. Now, these things are dwarfed by what we saw in 2020. But at the time, 12%, 14%, 17%, 14%, 20% growth in M1 was extremely scary. When money supply rose in 1982, because Volcker and central banks around the world said, let's open the sluices and get us out of this great severe recession. It was the deepest recession since the Great Depression at the time. And they opened the sluices and they pumped up money supply, and we got out of the recession in 6 months, and they staved off a international sovereign debt crisis in Latin America. Then they started selling bonds and sopping up all that excess liquidity in the money supply to pay for Reagan's deficits. And you never saw the inflationary consequences. And in fact, inflation was in that process of going from 14% down to about 3%. Money supply increases do not necessarily lead to higher inflation. Well, we saw an outsized move, unprecedented by magnitude, in 2020. And a lot of people are talking about hyperinflation being a natural consequence of that. And I apologize, this chart is only through December 2020. I decided to drop this in at the last moment. This chart shows you M1, and you can see that big increase in 2020 into 2021. And you can see the growth rate in M1, not the actual levels of M1 in circulation, but the growth rate has come way back down. So there's a great possibility that once more, as has been the case since 1982, you will see inflationary consequences of monetary largesse sterilized. We're seeing higher inflation, but we may not see higher inflation for 14 years the way we saw it in the 1970s. So if you're still living in the 1970s, you probably need to get rid of your leisure suits, and you probably need to modernize the way you think about the world. The dollar hasn't fallen. I keep hearing that it's collapsing or that it's going to collapse. It's 30% higher than it was. You can see from 2005, 2015, the trade-weighted dollar was trading in this range, 80 to 90, basically, actually 80 to 85. Now it's trading in a range of about 95 to 105. It's 30% higher than it was at its bottom back in the previous period. The dollar is not collapsing. Put all this together, rising interest rates, a diminution, but not disappearance of the war premium, a diminution, but not disappearance of the inflation premium, and the fact that the dollar is going to be strong and probably the stock market's going to move to new highs. And you could easily see a situation where the gold price comes back down and continues to consolidate in that 1780 to 1880 range. I'm not predicting that the intermarket relationships, the way gold prices react to inflation, the trade weighted dollar, TWD, trade weighted dollar, stock markets, interest rate markets, I'm not predicting that the relationships are breaking down or changing. I'm projecting that the relationships that have persisted over the last half of a century continue with some changes. You can see the top line here. Inflation's correlation with gold price changes, 9%. Okay, I'll buy that. And remember, inflation was declining from 2000 till 2021, while gold prices were rising from $250 to $2,000. So the breakdown or the lack of correlation of inflation to gold was pretty good for gold investors because inflation wasn't an issue for those 20 years. But a host of other factors were issues that were driving investors to buy more gold and drive the price up. Trade weighted dollar negative 34%. You will think that gold trades against the dollar, you'll be wrong 2/3 of the time. Congratulations. We know a few prominent investors who believe that, did that, and they're less wealthy than they used to be. Stock market, negative 5% correlation over time. T-bonds, T-bills, 1% to 1%. Basically not correlated. At this point, I'm going to turn it over to Rohit Savant. He is the head and director of our precious metals research operation, and he is the primary author of our reports. And I will let him go through the information about supply, demand, investment demand, etc. He'll kick it back to me to give some final words about Russian gold because it's the topic of the moment. And we will go from there. Rohit, are you ready to take over?
Yes, thank you, Jeff. So I'm going to start here by talking about gold investment demand. Gold investment demand last year dropped to 27 million ounces, down from around 40 million ounces in 2020. You had the availability of vaccines, the reopening of the economy, healthy economic growth around the world, extremely strong equity markets, real estate markets, all of which came together and weighed on gold investment demand during the last year. Now, despite that decline that we saw in gold investment demand during 2021, by historic standards, gold investment demand last year was still pretty high. Investment demand during 2021 was supported by a variety of different political as well as economic risks. So some of these risks, like growing government debt, predate the pandemic, and the pandemic actually worsened the risk associated with this growth in government debt. Another issue that arose during 2021 was the strong stimulus response from central banks and governments to the pandemic, which helped to shorten the duration of the pandemic-induced recession, but also resulted in an excessively strong level of demand during 2021, which then resulted in pushing up inflation and was another reason why there was support for gold as an inflation hedge during the last year. You've also been seeing as an ongoing theme over the past several years, a deterioration in cross-border political relations. And this is something that has been providing support to gold investors and gold investment demand. And these political tensions can have serious repercussions for the global economy. That's something we're getting a first-hand look at the moment with the war between Russia and Ukraine. In the near term, intensification of inflation and concerns about economic growth due to rising inflation, we believe will continue to support gold investment demand this year. And then you have the rising interest rates, which are expected to act as a headwind to all asset prices, including gold. However, we don't really think, as Jeff mentioned before, that interest rates will rise sufficiently to result in a sharp decline in gold prices. So historically, when you look at the relation between interest rates and gold prices, you need to see real interest rates rise above 3% for gold prices to decline in any meaningful way. While the Fed is focused on curbing inflation, and we do expect interest rates to go up, we really don't see nominal interest rates rising sufficiently to result in real interest rates getting up to 3% or higher. So with all of that in mind, we expect gold investment demand to remain high this year as well, and actually rise a little bit by about 2.5% to 3% over last year's levels, to somewhere between 27.5 to 28 million ounces in investment demand for 2022. So there are various factors that influence gold investment demand. And on balance, these factors, like the use of gold as an inflation hedge or a safe haven asset, they're expected to be supportive of gold investment demand during 2022. Gold's use as an inflation hedge, a safe haven asset, and as a portfolio diversifier, we believe these three uses would be the most positive factors for gold investment demand, with some of its other uses as a currency hedge or a form of saving being somewhat less supportive, but still positive in general for gold investment demand during 2022. So inflation is front and center in investor minds at this time, and there are concerns that inflation could spiral out of control. We believe the more likely scenario is that inflation will be brought under control over the next year. Jeff went through the details of expectations for inflation. And while we do expect inflation to stay higher than where it was between the Great Recession and the pandemic, we really don't believe that it's going to spiral out of control, or that we're likely to see sustained high levels of inflation like we saw during the 1970s. Nonetheless, in the near term, investors are expected to keep adding gold as an inflation hedge, based on that concern that things could get worse than what they are at the moment. Then you have gold's role as a safe haven. And after 2020, this attribute of gold, we think, will regain some importance in 2022, especially after Russia's invasion of Ukraine. I mean, that really brought to the forefront the need to have gold as a portfolio diversifier and a part of your portfolio in the time of crisis, which can hit at any time. And then lastly, lofty asset values. You still have real estate prices, and you still have equity markets at extremely elevated levels, and they are vulnerable to weakness in the near term. So with that in mind, investors will be looking to add gold as a portfolio diversifier during 2022 and in the coming years. So what you're looking at here is a gold held by ETFs, and ETF holdings declined by roughly 10 million ounces during 2021, after rising around 31 million ounces on a net basis in 2020. And these changes reflect the broad investor sentiment towards gold that we've been observing over the last 2 years, where you saw a strong increase in investment demand during 2020. Saw some weakness, but still high levels of investment demand during 2021. And then through the first quarter of this year, you've already seen investors adding back on a net basis around 7 million ounces of gold to ETF holdings. So this year again, we expect gold ETF holdings to rise and at least remain at the elevated levels that we saw during 2020. So coin demand continued to rise in 2021, finally exceeding the levels that we saw in 2013. Now, these investors typically tend to be long-term, more price-sensitive investors, and the relative softness in gold prices that we saw last year, coupled with the numerous long-term political and economic reasons to be buying gold, saw an increase in demand for these products during 2021. And so last year, the demand was at about 8.4 million ounces, which compares to about 8.2 million ounces in demand for these products in 2013. And this year as well, in the first few months of this year, we have been seeing ongoing strength in demand, and the fact that these investors who are typically price sensitive are willing to buy gold coins at current price levels and with the high premiums on these products tells you how these investors specifically are thinking about gold as a long-term asset, and that they still see value in owning gold even at these higher prices. So with that, we'll move on to supply. So what you're looking at here on the left-hand side is total supply. Total supply rose at a relatively weak pace during 2021 from 2020's depressed levels. Total supply, which includes mine supply and scrap supply, stood at about 126.9 million ounces during 2021, which was up about 1.4% from 2020. Now, when you exclude 2020, total supply during 2021 was actually the lowest since 2015. Now, the general weakness that has been observed in total supply can be attributed to weakness in mine supply, which declined in every year pretty much between 2018 and 2020. So the weakness in mine supply that we've been seeing over the past few years as a result of some large mining projects that have either been suspended or are producing at lower levels, either due to political reasons or due to mine-specific reasons. And this issue was further compounded by the fact that there's been a sharp reduction in investments made towards developing new projects. In 2020, the mine supply declined sharply, primarily due to the pandemic. And while it rose during 2021, the rebound was fairly weak due to the suspension of projects prior to 2020. And the lack of investment, which has resulted in few new projects available to replace the lost mine output due to the suspension of some of those big projects over the past few years. On the scrap supply side, you've been seeing a fairly healthy growth in scrap supply over the past several years now, primarily driven by higher prices. There was also a strong increase in scrap supply during the pandemic. However, when you compare the increase in scrap supply during the pandemic to the increase in scrap supply back during the Great Recession, there is a big difference. And we primarily attribute that to a substantially larger amount of monetary as well as fiscal stimulus provided during 2020, 2021, which resulted in fewer people needing to sell their gold to raise money compared to what was seen during the Great Recession. So what you're looking at here is the new capacity additions. And as mentioned before, one of the primary reasons for the weakness in mine supply has been the decline in new capacity that has been brought on stream in the past several years. And this reduced capacity makes global gold mine supply more vulnerable to disruptions similar to those that we've been seeing in the past few years. And one of the primary reasons for the decline in capacity has been the decline in exploration spending since 2012. So there was an uptick in spending during 2021, which is likely to continue at least in the near term. But the benefits of this spending are not likely to be felt for several more years. The recent uptick that we've been seeing in spending can be attributed to the higher gold price, which we are expecting will last at least in the short to medium term. It is worth noting that the gold price in 2021 was substantially stronger than what you had back in 2012. Yet the spending is relatively lower. And this really highlights what's going on in the mining industry, where mining companies have become a lot more disciplined with regards to spending money. So while the number of projects that are coming on stream or are expected to come on stream in the coming years are fewer in number, the quality of these projects that are being developed is a lot better than some of the projects that came on stream in the last run up in gold prices. This is the breakdown of production weighted all-in sustaining costs, which stood at 1150 in the third quarter of 2021, which was the highest level of all-in sustaining costs since the second quarter of 2013. So all-in sustaining costs have been rising since the beginning of 2019, and the trend is expected to continue into 2022. A combination of factors came together to push costs higher, which include a decline in mine production, which in effect reduces the number of ounces over which these costs can be spread. You also had an increase in gold prices, which incentivized mining companies to mine lower grade ore, and also resulted in the increased costs of labor. And then more recently, there's been an overall boost in inflation due to the supply chain disruptions, the high energy costs, all of which is expected to play a bigger role in boosting costs in 2022 than it did in the past few years. So with that, we'll move on to fabrication demand, which stood at 89.3 million ounces in 2021, which was up about 15.6% from 2020 levels. And this was the first increase in gold fabrication demand that we've seen since 2018. Much of the gain that we saw in 2021 was a recovery of lost demand from 2020 due to the pandemic and the high gold price that year. That said, gold fab demand in 2021 was still lower than the 94 million ounces in demand that we saw during 2019. And much of the gain in demand during 2021 can be attributed to the relative softness in prices in 2021 compared to 2020, an uptick in demand from some regions due to improving economic conditions, and an increase in demand from some countries where gold is used, gold jewelry is used as a form of savings. So all of these factors collectively help to boost gold fabrication demand during 2021. On the central bank demand side, in addition to an uptick in fabrication demand and healthy investment demand, central banks added to their holdings during 2021. Central banks added about 10.8 million ounces of gold to their holding during last year, and this was up from around 8 million ounces in net additions during 2020. So central banks are expected to continue adding gold to their holdings during 2022, potentially adding about 9 million ounces to their coffers this year. They still have a lot of reasons to continue adding gold to their holdings. They continue to try and diversify their reserve assets. And while the start of the year has been somewhat weak for central bank demand this year, we do think that slightly lower prices in the second half of this year compared to right now should encourage increased gold buying by central banks. So this chart shows the relation between the gold price and the net additions or reductions in gold holdings with central banks. And central banks have typically been fairly price sensitive have been fairly price sensitive. Now, what is interesting to see over here is not only that when prices were declining during the 2013-2018 period, you did see a pretty substantial uptick in central bank gold demand. But what is more interesting is that last year, when gold prices were at record high levels on annual average basis, in a year of that sort too, you saw an increase in demand from central banks, which was in a way a departure from the typical trend that's been seen in the past. And that suggests that, like coin buyers, central banks too see value in adding gold to their holdings at these higher price levels. So you did see a lot of buying by central banks between the 1780 and 1840 level when prices were in that range during 2021. So with that, I'll pass this back to Jeff to speak about Russian gold.
And you pass the screen back to me. Right. Thank you, Rohit. I want to talk about Russia's gold. It's obviously very important right now, given the war. And there's also a tremendous amount of misinformation that's floating around related to it. First off, let's look at Russia's gold and money. These were its central bank reserves at the end of January, the most recent numbers that are available. Russia had built up a war chest, and it was in fact a war chest, of nearly $470 billion of foreign exchange. It also has built up over the last 12 years or so, 14 years, a war chest of $132 billion worth of gold, or $73 million worth of gold. A big part of its foreign exchange has been frozen. A big part of it, perhaps as much as 200 billion of it, was in banks in countries that have frozen the central banks of Russia's assets. Another 150 to 200 billion appears to have been deposited in yuan deposit accounts with the People's Bank of China. And about 2 weeks ago, the Russian central bank asked the People's Bank for its money back in dollars. And the People's Bank said, no can do, sir, sorry. There are international sanctions against you. And those sanctions have threats that if a third party trades with you, they could come under sanctions too. And the People's Bank of China cannot risk that. So we're going to keep your foreign exchange reserves in yuan until further notice. So they are kind of tight for cash. They're still selling oil and gas in Europe and China and India, and they're being paid for it mostly in euros and in other currencies, not necessarily rubles, by the way. So that's part one. Part two of reality is the Central Bank of Russia has about 74 million ounces of gold that it has built up over the last 30 years, mostly over the last 15, 17 years, when the oil price started rising in the mid-aughties and stayed high ever since then. And you can see that in the central bank data. And I should say that all of the information that Rohit has just gone through, there's all kinds of, I mean, this is a 250-page report. There's enormous volumes of charts and tables with all of the data behind it. So you can, for example, see annual levels of Russian monetary reserves of gold in a table form, and you can see when they were adding gold to their reserves. They have about 74 million ounces, $132 billion worth of gold at the end of January. Prices are a little bit higher now since they attacked their neighbor. They represented about 19% of their total monetary reserves, much of which, the rest of which has been frozen. Now there are a couple other factors that are there that floating around. First thing is you hear these people saying that Russia has pegged the ruble to gold. It has not. Russia has done two things since it invaded Ukraine related to gold. The first thing was that it went to the oil importing countries, oil and gas importing countries in Western Europe, and said, you must pay for your imports of our oil and gas in rubles. The ruble fell sharply once it invaded Ukraine and sanctions were put in place. And it was trying to support the ruble by making these countries buy tens of millions of dollars worth of rubles. They said, no, we have contracts with you that say that we will buy this stuff and we will pay you in dollars or euros, and we will honor our contracts. And this went on for a couple of weeks. So then the Russian central bank comes back and says, okay, you can pay for it in rubles or gold. And the Western Europeans said, no, we're going to pay for it in dollars or euros. That's what we're contractually obligated to do. That's what you're contractually obligated to accept. That's the way it's going to be. So last Friday, the Russian government said, okay, you may pay Gazprom Bank in euros, and Gazprom Bank will immediately convert those euros to rubles. And so that's how it's been. And you can see the ruble started to recover because Gazprom Bank had to go out and scrounge and find rubles just to convert all of those euros that it was receiving into rubles. But no one has been buying oil and gas and paying for it with gold. And the oil and gas prices that they're selling at are related to international oil and gas prices. They're not pegged to gold. The second thing that they did is they said they will buy gold from domestic Russian mining companies and refiners and pay for it at 5,000 rubles per gram. Now, at the time that they said this, about 2 weeks ago, the international price was about the equivalent of 6,000 rubles per gram. So it was about a 16% discount, right? They weren't pegging the ruble to gold. They weren't saying to anybody else that they would buy gold at 5,000 rubles per gold per gram. They were saying, we will buy gold from domestic mining companies and refiners at 5,000 rubles per gram. Now, if you've ever looked at the sugar market or the oil market or the gold market or other markets, and you've seen a government say, we're decreeing that the price of this commodity, whatever it is X, and X is at a 15%, 16% discount to the price you can receive elsewhere, a funny thing happens. People stop selling to the central bank, right? They may not be allowed to sell elsewhere. They can sell domestically, and we've seen a tremendous surge of domestic investment demand for gold because the ruble's fallen, because the banks were shut down, because the stock market was shut down, and a variety of other issues. So they can sell domestically at domestic market prices. They can sell at a discount to that, to the central bank, but they can't really export their gold yet at this time. Not a peg. It's this for these group of companies, these refiners and miners, they can buy gold there. So they're not buying gold, from what we can tell. The gold is sitting unsold because who wants to get that discount? And even if they were offering this deal to others, and they're not, because they need to preserve their foreign exchange reserves, what's left that they have access to, even if they did, you would have to be a non-economic participant of the gold market to say, oh, I could sell my gold at X to anyone in the world, but I'm going to sell it at a discount to X to the Russians government. Yeah. That's not capitalism, if you will. So the situation is they've had not pegged the ruble to gold. They have no plans to peg the ruble to gold. Even if they did, it would be meaningless to the international gold market and the international currency market. So it's just not an issue. There's another thing that I'll talk about. This is from our 2002 gold book. And Russian mine production, secondary refinery, exports, domestic consumption, everything was state secrets under the Soviet regime. And they stayed state secrets until around 2001, 2002. And some of those things are still state secrets. CPM Group and its predecessor operations, the Commodities Research Group at J. Aron and Goldman Sachs, cobbled up these numbers, and we kept them going. You can see it goes, well, you maybe not be able to see it. It goes back to 1950. What our estimates were of mine production, we don't put secondary recovery and fabrication demand in here, but it's there, exports and government reserves. Now, it was all state secrets. So it was our best guess based on information that was available in the non-communist world. We saw a few things that led us to believe that we were kind of accurate. The first one was in 1989. Russia joined the IMF. And as part of the IMF, you report your monetary reserves on a monthly basis to the IMF. And you can see, or maybe you can't see here, but in 1988, our estimate was that they had about 70, 74 million ounces of gold that the government of Soviet Union held. And our counterparts in Soviet Union said, we're going to join the IMF and we're going to tell them that we have 12.9 million ounces of monetary reserves. And we said, oh my gosh, we're like 75 million ounces. So we're like 55 million ounces too high. And they said, no, don't change your table. These are monetary reserves. There may well be other gold reserves that other parts of the Russian government own. We're not allowed to say because it's state secrets. But don't go changing your numbers on your table just because our monetary reserves are 12.9%, 12.9 million. So that was one indication that maybe we were somewhat accurate. They actually did a Eurobond offering, I think in 1989, where they came up with some numbers that kind of supported our numbers and said, hey, our numbers look like they might be accurate. And when people say, oh my God, the Russian Soviet government has disclosed how much metal it has, not just gold, but also copper and diamonds and other things, the Russian reaction was, no, these are Western estimates. But then the Soviet Union dissolved in 1991. And you had 15 independent republics, and the other 14 republics said to the Russian government, we want our share of the government's gold. And the Central Bank of Russia said, okay, here's your gold, and on a pro rata basis. And the Ukraine Central Bank said, you gave us our pro rata share of 12.9 million ounces. But we read someplace that maybe you have as much as, by that time it was down to about 68 million ounces. So we want our share of all of the gold that the Russian government owns. And the Central Bank of Russia said to the Central Bank of Ukraine, look, we gave you our share of the we gave you your share of the monetary gold we control. If you want to get a share of the other gold, go talk to the Red Army, the Russian army. Suggesting that the Russian army might have a stockpile of 50, 55 million ounces back then. And every indication we have is that it's still there. Now, there's another question that's come up, which is where is the gold in Russia? And the central bank gold and the army gold appears to be mostly stored in a very large vault that was built in the 1990s in Moscow area. It used to be that the gold was dispersed in various vaults around the greater Moscow region. But in the 1990s, they built a very large vault. And they asked certain people in the West, hey, you have been involved in moving large amounts of gold. How do you do it? And that also provided some insights into it. Now, the Russian army apparently is not getting along too well with the Russian government. So the Russian government has 74 million ounces of gold, and it may have to sell some. It has a problem because the gold is owned by the central bank and there are sanctions against the central bank. So if they try to sell it to somebody else, they say, well, we might not want to buy it because there are sanctions. And if we are found out that we're buying gold from you, we could come under the sanctions too. But we might buy it on a private basis and on a secret basis. So there could be some private secret transactions. That's one of the reasons why people like gold, why people own gold, because of the secretive nature of it and the privacy that it affords you. Obviously, they probably get a discounted price for that. It could happen. If a central bank or a couple central banks bought the gold, they would add it to their reserves. They might not add it to their monetary reserves immediately. They might hold it in a special account and add it to their reserves later, so as to not look like all of a sudden their gold reserves, their official monetary reserves are rising, just as Russia is facing the need for foreign exchange capital. If they could probably also sell it to some bullion traders who would be willing to risk skirting the law. And that metal then would probably be trickled into the market. So that's the story on Russian gold. We buy the book, 250 pages, detailed data, incredible data that you'll find nowhere else in the world, and excellent, unbiased analysis. We'll come out with our silver yearbook in early May. We're working on it now. We're collecting silver yearbook sponsorships, and we'll launch it with another briefing. And then in late June, we'll come out with our platinum group metals yearbook too. I have posted here, and you probably can't get a live thing off of this, but you can get them from the notes attached to this video on YouTube. We gave an excellent interview to the Northern Miners podcast this week, yesterday, on the way central banks, the US Treasury, and the Russian government manage their gold. A lot of history and a lot of insights. It's kind of a longish podcast, but I think it's an excellent place where you can learn a lot of information about the history of gold and central bank gold that you will not find elsewhere. We also did an interview on Friday on Kitco, focusing more on Russian gold and some of the inaccurate misunderstandings that are pervasive among gold bugs right now. We did a video on Monday on the truth about Russian gold and the ruble, again, because of those issues. And I'll say one last thing about that. The people who think that, or the people who are marketing the idea that Russia has pegged the ruble to gold, and that this somehow or other is the beginning of the collapse of the dollar-based de facto currency regime, reserve currency regime, are the same people who have been predicting that the dollar is going to collapse for the last 10, 20, 30, 40, 50 years in one case. Don't like the dollar and believe that it's got to collapse. And they've been wrong for a half of a century or less. And they find any reason. So when the war started and certain banks in Russia were disconnected from the SWIFT, this was clearly going to lead to a collapse of the dollar, which it clearly hasn't. Now, oh, well, the Russian pegging gold to the ruble to gold is going to lead to a collapse of the dollar. These people are telling you what they believe or what they want you to believe. They're not talking from any empirical information. We also have our retail investor program, which provides a lot of information. You can buy the Gold Yearbook. You can become a retail investor and buy into our program for retail investors, where we're also bolting on some option strategies. And if you are signing up for the retail investor program, you get the 3 yearbooks as part of that package. including the Silver Yearbook next month. We have a precious metals advisory and a variety of other things. We have added a tantalum unit to our research operation. It became available, and it is a unique thing, a research operation on tantalum supply and demand and price. So we've created the tantalum market practice. We have a very big practice on other metals too. We have a base metals advisory. We have a lot of work on battery metals. We've been studying high purity electrolytic manganese metal and high purity manganese sulfate, which is used in battery manufacturing for electric vehicles and other applications. We've been studying that stuff for more than a dozen years right now. So we've been saying, yeah, pay attention to manganese because it's the substitute for cobalt. And we've been saying to our investor clients, don't buy cobalt because it's going to be substituted away to manganese and nickel. So there's a lot of things that we do that might be of value to you, and you can learn about them on our website. I'm going to open it up for questions now, and Carlos Sanchez is going to sort of do the air traffic control on the questions. So Carlos, if you have questions for us, go ahead and shoot.
Okay, we have several questions. So the first one, as the price of gold is uncorrelated to so many other assets, what percentage of a portfolio should one have in gold to achieve the risk-return efficient frontier as proposed by modern portfolio theory?
Yeah, we've done this work, and people who have watched our videos or read our reports have seen it. Ibbotson and Associates ran those numbers in the early 1980s. We took their methodology, which is an efficient horizon, and reran it. And we found that from 1968 to 2020, 2021, the optimal percentage of a diversified portfolio that would have given you the best risk reward ratio was somewhere between 25 and 30%. That's very high for a lot of people. The trope was that it was 5 to 10%, which was based on the work that Ibbotson had done in the early 1980s when you had free gold prices from 1968 to 1980 in their initial calculations. Taking it up to the present and everything that's happened in the world, it's probably about 25, 30%.
Okay, next question. Has CPM Group looked into the growing derivatives reported by banks on the Office of the Comptroller of the Currency Report on derivatives? Is the activity more index-based related or simply selling of various paper products sold to investors or institutions?
Started to look at that, but quite frankly, we don't believe that it's a particularly important issue. We think it's one of those things that the guys who were trying to scare people into precious metals and tout conspiracy theories are. If you look at the relationship between large derivative positions as the OCC reports them and gold and silver price changes over the last 40 years, there isn't one. You have people who keep focusing on that stuff and saying, oh my God, look at these large positions that, JP Morgan has, and now it's Bank of America that they're trashing. This is going to blow up and cause silver prices to rise to $700 and stuff like that. They've been wrong for 40 years. They clearly don't know what they're talking about. This stuff really doesn't matter. Some of it is probably related to indexed investments. Some of it probably is related to other investment products that are being sold. A big part of it has to do with the use of precious metals, especially silver, and the fact that that metal is leased out by bullion banks to fabricators. All fabricators all along the fabricating chain. So it's not like, oh, we're using 100 million ounces of silver. We're using 100 million ounces at 5 different plants as the silver goes through the process, manufacturing process. So most of it probably actually represents leasing to fabricators. And then there is clearly a portion of it because if you look at the gold and silver prices, if you look at gold and silver investment demand, gold and silver investment demand in 2020, 2021 was basically double what it was in 2018, 2019. So, you know, you shouldn't be surprised to see that kind of increase.
Okay, next question. In South Africa, there is a huge amount of unrecorded or illegal gold that is mined along the old Central Rand in the Free State, where once famous mines have been closed. There also is illegal mining in many other countries. Do you include any illegal mining estimates in your supply, or have you any comments on illegal gold flows?
I'm not familiar with the illegal mining in South Africa. We are painfully aware of artisanal mining in South Africa and in a number of other countries. Sometimes it's artisanal, it's, you know, pick and shovel type of stuff, or panning. It's not necessarily illegal, but it's not modern mining as we know it. And we try to include production estimates on that. It's very hard because a lot of it may not be illegal, but it is outside of the normal channels in which gold is produced, processed, and sold. So it goes unreported. And, you know, one of the things that we've learned over the last 40 years is the extent to which you have a large amount of, the amounts of gold being mined on an artisanal basis in countries like Bolivia, Peru, and Ecuador are much larger than a lot of people thought. And the artisanal mining that you see in West Africa probably is about closer to the levels of what we thought. And then South Africa, like I said, you know, there are several of the old tailings dumps, some of which go back 130 years, that are being mined or recovered on a heap leach basis, and it's not artisanal. And that metal flows into the system pretty regularly.
Okay, we have one more question. What is your forecast for gold prices this year and beyond?
I said earlier that we wouldn't be surprised to see prices will stay high around current levels while the war in Ukraine continues. And depending on how that battle proceeds, you have the potential for prices to spike higher. And we have written in our trade recommendations that our retail investor clients get and elsewhere, that we wouldn't be surprised to see the price spike to 2,100 or even 2,200, depending on how that goes. And if you listen to General Mark Milley's testimony before Congress yesterday, yeah, it could go higher because we are in a treacherous place globally, militarily. So it's hard to say. But we think in the second half of the year, you lose a big part of that war premium because things have settled down. You lose some of the investment or inflation premium, and we would not be surprised to see the price trade between 1780 and 1880 in the second half of this year, along the lines of what we saw last year. Beyond 2022 into 2023, we think that the price could start rising somewhat. Our expectation is that the next financial crisis of note and recession occurs sometime between 2024 and 2026. It could be 2025. It's hard. It's very hard to predict exactly when all of the problems come home to roost, but you can be sure that the problems will come home to roost. At that point, we would expect gold prices to rise to record levels. And we've said that for several years now. Actually, we've been saying that since the gold price started to drop in 2012, 2013.
Okay, that was the last question, Jeff.
Well, if there are no more questions, we will thank you for joining us today. And we look forward to you joining us on May 10th when we release our silver survey for the year. Thank you and have a good day.